Welcome to Inevitable Wealth from Liberty One Wealth Advisors, a conversation around financial decision-making and events around the globe. In the age of instant information, level heads can be hard to find. Our hosts, Guilian DiLeonardo and Jacky Petit-Homme, provide objective and relevant insights to help you parse the data and block out the noise as you build your wealth. As managing partners of Liberty One Wealth Advisors, Guilian and Jacky look to empower you to develop an increased understanding of financial markets and how they impact you.
Hello, everyone. Welcome to our second episode of Inevitable Wealth. We're looking to clear the air around some topics and misleading headlines that we came across in our everyday lives. So, of course, I'm Jacky Petit-Homme, and I'm here with Guilian DiLeonardo. Guilian, good morning.
Good morning. Good morning. Good morning.
Wonderful. So let's get into it. Yesterday morning, I was reading the Wall Street Journal, and I came across an article that really, sent my brain into a lot of different avenues. And the exact name of the article was Fidelity and State Street push to make 401ks more like pensions. And I think, of course, like any article out there, they want you to click on it and create curiosity. But, Guilian, explain to us, what does that mean?
So what it means essentially is that more retirement plans are going to offer annuity options within their overall platform, in their menu of funds. So for the most part, they're going to start to put annuities into the life cycle or target date funds that you may come across in your 401k or 403b. So if you were to select a life cycle 2050 fund, right, that means they're expecting you to retire in 2050. A portion of that fund will be invested into an annuity. These funds have historically been a great option for, essentially people looking for a one-size-fits-all automated type vehicle, right? Because they start off more aggressive, they get more conservative as time goes on. Naturally, like your investments may probably be best for you to do that. They're often also the default option in many retirement plans. So when you first sign up, you're typically auto-enrolled in one of these because they are a great fit for a lot of people. So within those funds, they're looking to incorporate more annuities.
Okay. And as many folks listening or watching may know, annuities are definitely not new, right? Annuities have been around for decades, and so have 401k plans. So, Guilian, can you, I don't want to use the word speculate, but can you maybe guess or maybe just, think like, why now, right? If annuities and also 401ks have been around for a pretty long time, why all of a sudden the idea to put those annuities in 401ks?
Yes, I think it's pretty clear. Money. So money. They can make a lot more, right, when they start to incorporate these high cost products into their funds. So over the past, 20 years or so, you've seen the cost of investing get so much cheaper, right, for individuals and families across the US, across the globe. So essentially a fund, and the funds we use, Jacky, cost something like 0.06%, right, almost negligible, right? And you've seen that across the board. Oftentimes 401ks have even more cost-effective options than you may see elsewhere. And what that means is that these companies are making a lot of money, right, in their 401k platforms and their fund offerings. So by putting something that is a high cost product, a high margin product in there, right, and not even really offering it as its own fund, but putting it in something that already exists, they can increase the cost, increase the revenue pretty seamlessly, right, if you really think about it. So if they embed it into these funds, the article goes on to say that the cost goes from something like 0.1% to 0.2%. It doesn't sound like a lot, right? 0.1 to 0.2%. So a small increase to an extent. But in these plans, do you want to guess how much money is in these plans?
I mean, I can imagine, right? Like that's like
Trillions.
trillions. Okay, I was gonna say a couple trillion, but I don't know how
Target date
much.
funds, target date funds hold a third of. There's about 9 trillion in these retirement plans. They hold about a third of it. So $3 trillion times 0.1% really adds up if you just across the U.S. extrapolate that data. So it's all in my opinion, right, about money. I also really did not love the headline. I think pension has such a positive connotation, right? A lot of folks who have pensions, right? It's company sponsored. It's a great benefit. Annuity does not have a great connotation for the most part because they are oversold, in my opinion. But I found that to be questionable, right, in terms of how they present it, because it's not a pension. They're trying to make it more like pensions, they say, but it's not a pension. So let's look at the good, bad, and the ugly as a potential move. Jacky, what are your thoughts on it from your perspective?
Yeah, I mean, I have thoughts. So, I mean, let's talk about the good thing, right? Annuities are not a bad thing, of course, right? Annuities provide guarantees, right? There are folks out there who might be in a position where whether they are nervous about the market or they amassed a nest egg where they can use an annuity effectively in their financial planning. And annuities pay you guaranteed income, a lot like a pension. It's essentially creating a pension for yourself. And when you invest in an annuity, right, which is an insurance product, right, these are offered by insurance companies. Essentially what you're saying to that annuity company is, I want you to bear the market risk for me. No matter what happens, if the market goes up or down, sideways, you're going to guarantee me this income when I hand over you a lump sum of cash. So it's good, right? If the market drops down 20% the next year, or if we had a year like we did last year in 2022, it's wonderful to see your balances, stay steady. And that peace of mind helps a lot of folks. But in some cases, right, it may not be great, right? Because like we know, right, Julian, we could get into this, is what are you giving up, right? If you're giving up over a large sum of money to a company, they're bearing the risk for you, but they're also going to bear the reward for you, right? Especially if you're looking at a long-term investment horizon. So, in some cases, like I said, it's ideal for folks who may not be looking to leave behind an inheritance. They want to maximize and make sure that their income is, guaranteed over time. But with all good things, right, every rose has its thorn, and we could talk about that. So, Julian, let's walk through some of the cons of why you should or should not have an annuity.
Mm-hmm. Yeah, I think we talked about the costs a little bit. They tend to be high cost, right? So within the 401k, we saw that cost would essentially double, right? Outside of a 401k, you often see costs upwards of 2 to 4%, right? So that's a very high cost, considering that in the market, you're typically averaging in the single digits, right? If you extrapolate over a long-term time period, so that adds up. They are not liquid, right? So what that means is if you need the funds, typically you may have to pay a surrender fee in the short term, or they essentially lock you up for up to 7 years. I know we've had discussions where clients we work with have money at TIAA-CREF, right? Because they're in education oftentimes, and TIAA-CREF has something called fixed index annuities, right? A guaranteed amount. Sounds great on paper. When the client looks to move it out, they can only take 1/10 per year. So anytime we start working with someone at TIAA-CREF, it's a process where we can move over most of it, but anything in that fixed index takes 10 years to get it fully out, which I think is not fair to them, right? Because if they're not working with a professional, the burden on them is tremendous, right? To make that adjustment, stay on top of it, and understand those moves each year. And I think with that, you talked about the risk return adjustment. With annuities, and correct me if I'm wrong, the annuity company returns that they are getting when they are investing, right? Because they are effectively taking your money and investing, are not all that much higher, right? If at all, than the returns that the average investor can get, right? Someone who stays invested in the market for long term. It's not like these annuity companies, insurance companies are investing in some extremely savvy, right, high growth way where they're getting 15% a year, right? What I've seen are, again, single digit numbers that are entirely achievable for the average person. So to an extent, you're just paying for that security. It can be a good fit for a lot of people, but it doesn't necessarily mean that they should put in a large portion, right? Typically it's a sliver or something where the tax efficiency, right? Because can be reasons to do it from a tax perspective. If you are a high income earner or you're looking to essentially optimize your estate planning. But for the average person, generally I've found it's best just to be in cost effective funds. It's my perspective. What would you add to that?
Yeah, I would agree too to the tax benefits. I think it was you, Julian, said the insurance companies have great lobbyists, right? Because they basically got the government to agree to create these annuities that you get the tax benefits of a retirement plan that really have no limit. So if you're looking at someone who is a high income earner, you have a very large lump sum, and you want to defer those taxes into the later time, depending on what your risk appetite is, it may be a good fit. But sometimes we've seen situations, right, where like we'll talk to someone who's 35, 40, and they say, hey, listen, I'm growth oriented. I want to grow. I want to invest in the market. We say, great, send over your statements. And they have an annuity in their IRA, right? They had an old 401k, they changed jobs, and someone sold them an annuity. And
why do you think that is?
Well, because it's good commission, right? If whoever sold them, that person, the annuity, and one can extrapolate that potentially there was a miscommunication in what that individual's goals were, and what they needed, right? Because if you have an annuity, right, and in an IRA, and you did it for tax benefits, it's essentially redundant, right? It's like wearing a raincoat indoors. So our fear really is just seeing this be oversold, right? We call into 401k plans or 403b plans with our clients and the families we serve a lot, and you don't know who you're speaking with, right? They just pick up the phone. They know who you are because your account pulls up, but they don't know your situation. They don't know what your financial goals are. And I doubt they're running full financial plans on that 30-minute call when they're giving you advice. So it's just,
and they can't give advice on things that they don't hold. So really the only information they have is what their 401k value is, right? And your birthday. And they don't know the complexity of your life, right? I have a strong dislike for annuity companies, right? Because frankly, they should be called salesmen, right? Individuals who push these products. They're not fiduciaries. If we find someone where an annuity might be a good fit for them, right? We are fiduciaries. We are essentially working in their best interest as a holistic wealth planner. It's typically a small portion of the assets, right, where it might make sense. But again, that's typically pretty rare for us because they have to be either high income or have some sort of situation where we're trying to be extremely tax efficient or solve a specific goal. But a lot of these companies, right, because they pay somebody 5% of whatever they sell, it's far oversold, right? So the more people that are educated on it, and if you want to buy that and that's a good fit for you, great. But being educated on it is the first step in my view. So I know I'm ranting a little bit, but I can't, it drives me nuts. Because then somebody says, what do they say? I have a financial advisor. I'm like, okay, great. You're sounds like you're in great shape. Like, where's he at? And they say Northwestern Mutual. They say New York Life. And it's not the same, right? And it's just not the same. So you want to make sure people are just aware of what they're buying and what the incentives are of the individual that they're buying it from, because incentives drive behavior. So I'll stop there. I should dial it back a little bit.
Yeah. Yeah, but Julian does have a point, right? You want to know how folks are incentivized when they're working with you and offering products, right? And not to say annuities are a bad thing. Annuities are good tools. We just want to make sure that if you're investing in an annuity, that you're doing it responsibly, right? And that could basically is a good segue to our key takeaways, right? What are the action items if you're someone who has an annuity, considering an annuity, or you're now curious about annuities because we chose time to discuss it, right? So for one, I think, and Julian mentions, right, know what you own, right? Not only with annuities, but any type of security, any way you're invested, know what you own and know what the costs are, right? If you're invested in a basket of stocks, all right, that's pretty transparent. But if you have mutual funds, you should know what the internal costs are, right? If you have an annuity, you should know what those costs are, right? Because we want to make sure that, especially the families we serve, have ownership in their financial plan and understand everything that's going on. But that also helps you know what the true cost of that investment outside of the dollars that you're putting into that. What else, Julian? What are some key takeaways you would say?
Just being intentional about what you're buying and why, right? Every dollar you put to work for yourself should have a goal. And if that's a short-term goal, look to a money market. If it's a long-term goal, look to stocks and bonds, or essentially some variation, right? And if it's an income goal for a portion of your portfolio, you can absolutely look towards an annuity or something like that for a small piece. But for the most part, again, I think it's very important to understand, right, what those incentives are. You and I came across an individual the other day who essentially in their ADV, right, their list of their firm, right? So we have an ADV, every firm has an ADV, and it's all the disclosures. And they had to disclose that they are compensated to sell annuities, right, with trips, right? So someone sells enough annuities, they move enough product, they get to go to Cancun, right? So you just got to be aware of what that looks like for your specific situation. And I just want to reiterate, we're not anti-annuities. I think it can fit. Just know why, right? And know why you're buying it, why you're being sold it, and what that looks like overall. Is there anything you would add there?
Yeah, I mean, we don't want to, beat the idea to death, but basically, annuities, like any other financial product, are a tool at the end of the day, and like any tool on your belt, it has to be used for the job it was designed for. So there, the saying goes, right? Everything's a nail to a hammer, right? If you speak with someone who only sells insurance and annuities, their answer to your problem will be insurance or annuities, whether it's on purpose or not, but that's the tools they have. So,
or if you speak to someone in a call center, right, they have goals, bonus goals, right? They wake up and get an email that says, here's what we're looking to do today, right? Because they work for the 401k company, right? They don't work for you.
Yeah. So just be intentional, ask questions. I tell everyone we always speak to, questions. Know why and how it fits. What are the limitations of what you're invested in, right? There's pros and cons with everything. Even if you're just investing in stock has risk. If you're invested in bonds have risk. If you're invested in cash has risk. So know what you're invested in, be, intentional about it, and and work with a fiduciary. It always should be part of your financial plan, right? You shouldn't be taking investment advice if you don't have a financial plan, right? And I feel like that should be basic, but we should always make sure that we reiterate that. And I mean, that's pretty much it, Julian. Unless you have anything to add, that's all I've got to say about it.
No, I can go on and on, but I will stop it there. So thank you, everybody, for joining us. Much appreciated. We appreciate all the feedback from our first episode as well. We're always trying to deliver relevant content to you. If there's anything you'd like us to cover or anything you come across that you have questions about, you can email us at team@libertyonewealth.com, and we're more than happy to get back to you directly, and then also talk about it in a greater forum.
Liberty One Wealth Advisors is a registered investment advisory firm located in the state of Pennsylvania. Any options expressed are derived from sources generally believed to be reliable and are provided for informational purposes only. It does not constitute any form of advice or recommendation to buy or sell any securities, adopt any investment strategy discussed, or invest in any specific product. Nothing contained in this podcast constitutes investment, legal, tax, or other advice and is not to be relied on in making an investment or other decision.